This is an overview of Chapter 11. So we're going to talk about depreciation in Chapter 11. So there's depreciation, amortization, and depletion. Depreciation is the allocation of cost of tangible assets such as plant, property, and equipment. So a computer, a desk, a machine, a building. Depletion refers to natural resources such as oil, gas, minerals, and timber. And then we have amortization, which is the allocation of intangible assets such as patents and copyrights. It is also used as a general term to describe periodic allocation of costs. So what is involved in depreciation? So asset costs are necessary to acquire, all the costs necessary to acquire and prepare the asset for use and obtain the benefits from the asset. One key thing is service life or useful life. It is the amount of service or use that the company expects from the asset before it disposes. It can be affected by physical causes such as wear and tear. So maybe the factory can only, its service life is 10,000 hours, right? Because it's in hours that you run it. It can also be a function of time or damage or destruction. Functional causes are factors that limit the service life of the asset through obsolescence and inadequacy or even physical life not exhausted. Residual value is an important number. It's also referred to in many things as salvage value. It is the net amount that the company expects to obtain from disposing of the asset at the end of the service life. Accounting principles require that a company use a method of cost allocation that is systematic to calculate. The formula should be systematic and not just arbitrary, and it must be rational. The amount of depreciation expense in each period should relate to the decline in the asset's service potential each period. Now, the cost allocation, so the depreciable basis, I also refer to this in my spreadsheet, amount to be depreciated, is asset cost minus residual value equals depreciation base. So there are time-based methods of depreciation. Most common is straight line, and you've probably heard of that in accounting 1 or 2. And then there's accelerated depreciation, which is time-based, which is sum of the year's digits and declining balance. Then not time-based, but activity or use methods, appropriate when the service life of the asset is affected primarily by the amount of the asset is used, not the passage of time. And then there's group and composite methods. So straight line depreciation, which this should be a review, is appropriate when a company estimates the service potential of the asset will decline by approximately a constant amount each year during its useful life. So you take the cost minus the estimated residual value, which gives you your depreciable basis, and you divide by the estimated service life. The straight line method is most widely used. Here's an example of straight line. So to illustrate the most common depreciation methods, consider the data. The asset cost is $120. They purchased it on January 1st, 2018. The estimated residual value is $20,000. The estimated service life is 5 years or 10,000 hours. And then they give you a list of actual hours that you use this. So an example of straight line, so we have the beginning value, book value of the asset. And so to get to the depreciable basis, we take cost 120 minus the residual value 20, which equals 100, divided by 5. So depreciation for straight line purposes is 20,000 per year. We're going to depreciate to this residual value. So we have a beginning book value. We take depreciation expense straight line of 20,000. Accumulated depreciation is the sum of all depreciation. So we keep adding to each year's depreciation. And the book value is beginning value less accumulated depreciation equals book value at the end. So by the time 5 years is up, this is straight line, you will have depreciated the total of 100,000 and you will have a residual value or ending book value of 20,000. Straight line depreciation was just calculated there. So let's talk about accelerated depreciation. One of the ways to accelerate depreciation is the sum of the year's digits. This is when an asset depreciates more quickly in the beginning of the life and then tapers off. So the sum of the year's digits is recognized as a declining depreciation expense period by applying a decreasing fraction to each year of the depreciable basis. It's the number of years remaining in the asset's life at the beginning of the year divided by the sum of the asset's life. So I'm going to hit escape right now, and I'm going to take up the calculator. So just to show you, if it's a 5-year asset, the sum of the life is 5 years plus 4 years plus 3 years plus 2 years plus 1 year. So that's the sum of the digits, years digits, which is 15. So all 5-year assets will have a fraction divided by 15. So from the current slide, we take the depreciable basis of 100, which we calculated in the previous problem, and the years left at the beginning of this year, because we put it in service, is 5 years. We'll divide all of these years left by 15. So then you multiply 5 divided by 15 times 100,000. The depreciation expense is 33,333. The cumulative, obviously, you just have 1 year, and the book value is the 120 minus accumulated depreciation. So then the next year you would have 4 years left. So it's 4 divided by 5. You still take the 100,000, 4 divided by 5, and you get 26,667. Cumulative is the 2 of these depreciation years. You'll still, no matter what you do, it will change yearly what your depreciation expense is. And so if you do accelerated, you will have more depreciation expense and lower book value than on straight line, but you always get to accumulated depreciation of 100,000, and you always get to the residual value at the end of 20,000, no matter which depreciation method you choose. It doesn't change the ending amounts. Another accelerated method is the declining balance method. It's depreciation method that recognizes a declining depreciation amount in each period, applying a constant rate to the book value, not depreciable basis, at the beginning of the period. The declining balance is a rate of some multiple. So declining balance depreciation rate equals M, the multiple, times the straight line. In double declining balance, it's 2 times straight line rate. And then 150 declining balance is 1.5 times straight line rate. So here's an example. The straight line rate, I'm going to hit calculator here. So straight line rate, right, is 20%, right? So 20,000 was what the straight line rate divided by 100, right, equals 20%. We're going to double that, 2 times 20%. So that's 40% for double declining balance. And if we take the 20% on a 5-year asset and we multiply that by 1.5, then that's how you get 30% on the 1.5, or 150% declining balance. So from the current slide, you would multiply the beginning book value of the asset times the double declining balance rate. So in the first year, get 48,000 in depreciation expense, accumulated, of course, is 1 year, and the ending book value is 72. You have to carry that forward, which we'll do in the Excel example. And so you take the ending book value and you depreciate 40% of that. So now it's 28,000. You do this until you get to the final year. And in the final year, you should end up with 20,000 as the residual value. So you can, and you should only have accumulated depreciation of 100,000. So you just figure out how much do you need to get to the 100,000 and the 20,000 book value, and that's all you take in the final year. So if you use double declining balance, it only takes you 4 years to get rid of to depreciate instead of 5. In the 150% double declining balance, it would take you 5 years, but the final year is where you would figure out, okay, you have 28,812, so you only need 8,812 to get to the 100,000 and the 20,000 residual. We'll do more examples of this. Then we have activity depreciation methods. When the service life of the asset is affected primarily by the asset being used and not the passage of time. So activity or usage is usually measured in terms of output measures, such as hours worked, or output measures such as miles driven or units produced. So the depreciation rate is cost minus residual value divided by estimated usage of the asset. And depreciation expense is the rate times actual usage of the asset. So let's see that. So in this example, they had told us that there were 10,000 hours, and we are still using the 120 minus the residual value of 20, so 100,000 divided by 10,000 hours means this depreciates at $10 per hour. So then they told us in 2018, it's 2,100 hours. Multiply that by the $10 per hour, and you get depreciation expense of 21,000. and the book value of 99. Then you go to the next year, 2,500 hours times 10. And you'll do this until you exhaust the number of hours and you get to the 100,000 in depreciation accumulated, and you get to the 20,000 in ending book value. You still get to the same number no matter what. We're not depreciating beyond 100,000. Regardless of the depreciation method, the depreciation expense is generally recorded each period of the asset's service life by making a journal entry shown below. The credit is that a depreciation is the contra asset account called accumulated depreciations or allowance for depreciation. We will use accumulated depreciation in this class. So when you're using depreciation expense after you've calculated it, it's depreciation expense, accumulated depreciation is the credit. So while depreciation is normally reported as a current period expense, a manufacturing company may not expense all of its depreciation cost in the period, but instead include part of it as manufacturing overhead. As a manufacturing company includes depreciation on manufacturing assets as a cost of inventory by allocating depreciation of each unit during the year by increasing the work in process inventory account. This will happen in your cost accounting class. We won't cover that in this class. So depreciation, as well as depletion and amortization, is the process of allocation, not asset valuation. The purpose is to allocate the cost of the asset to expense in a systematic, rational manner, and the asset's book value should represent fair value both at the time of asset acquisition and at the end of the asset's life. While the majority of companies use straight line because of its simplicity, several other issues should be considered when selecting a depreciation method. So this is just showing that straight line is across the balance. The depreciation expense is the same every year, but double declining balance starts really high and goes down. But at the end, you end with the same residual value, no matter what the method is. So depreciation rate of return. So the way that you would do it is you take the net income divided by average book value of assets, which is the rate of return of 10.9%. So they took the net income, said it was the same every year. So talking about depreciation and maintenance costs, there are two additional factors to consider when selecting a depreciation method: repairs and maintenance costs, and the risk associated with the cash flow from the asset. So straight line depreciation assumes that the depreciation expense, and the maintenance would be spread over the life of the asset, right? If you have accelerated depreciation, the total is spread over the life of the asset, but maintenance expense would probably go up as depreciation expense is going down. Group depreciation is applied to a homogeneous assets that are expected to have similar service lives and residual values. For example, laptop computers. Applied to composite depreciation is heterogeneous assets that are related but have differing service lives and residual values. All the different items of equipment in a company's office. A company could use group depreciation when it owns a group of homogeneous assets with similar ages, useful lives, and residual values. Under this method, the company capitalizes the total cost of the assets into one account, treated as asset for the purpose of depreciation. The basis the group depreciates a rate on average life of the assets in the group. The calculation calculates the depreciation expense each period by multiplying this rate by the balance in the asset account, and then accumulated depreciation expense is a single contra asset account. Manola Company purchases 10 cars for $20,000, and the average expected service life is 3 years with a residual value of $5,000 each. Of those cars, 3 were sold after 2 years for $8,000 each, 5 after 3 years for $6,000 each, and 2 after 4 years for $4,800. What would be the group depreciation? So this is how they would do it. Group cost minus group residual value divided by average life of group assets divided by group costs. So 200,000 is 10 cars times 20,000 minus the 5,000 times 10 cars divided by 3 years. So the group depreciation rate is 200,000 per year. And then the 50,000 is the residual values divided by the 200,000. So the group depreciation rate is 25%. To record group depreciation, it would be cars, which would be a lump sum purchase, and we credit cash. And then the depreciation expense is 25% of the 200,000, so 50,000, and credit accumulated depreciation. The second year would look the same. Depreciation expense, credit accumulated depreciation. In the year that they disposed of the cars for $8,000, you would take in 24,000 cash, you would reverse the accumulated depreciation, and then you would wipe out 20,000 in cars. Then they go on to record the third year, and then they dispose of 5 cars in the end of the third year, and then they record the depreciation expense for the final year, and then they have a loss on the disposal because to wipe this out, they end up with a loss at the end. Composite depreciation may apply to depreciation of heterogeneous, dissimilar assets. It uses similar procedures as group. The company combines all the assets into one account and depreciates them accordingly. The company uses one accumulated depreciation account. The company does not recognize gain or loss on each item retired. The company recognizes a gain or loss when it retires the final asset. So Granville purchases 3 assets, A, B, and C, with costs of 25, 13, and 12, residual value 5, 1, and 0, useful lives are 10, 6, and 4, and annual depreciation is 2,000, 2,000, and 3,000, or 7,000 total. So assuming that Granville uses straight line, it computes the composite depreciation rate as 7,000 divided by the 50,000, or 14%. So depreciation expense is $7,000, or 50,000 times 14%. It would continue this process until the book value equals the estimated residual value of $6,000. If Granville purchases another asset, it may include the asset in the group by adding the cost to the asset account. When operating asset is made up of individual components that are significant with respect to total cost of the item, IFRS requires that the initial cost of the operating asset be allocated to significant components and each component be depreciated separately. This is called component depreciation. So how are depreciable assets disclosed? GAAP requires the following disclosures for depreciation. Depreciation expense for the period, balance of major classes of depreciable assets by nature or function at the balance sheet date, the total of accumulated depreciation either by major classes of depreciable assets or in total at the balance sheet date, and a general description of the method or methods used in computing depreciation with respect to major classes of depreciable assets. So that would be required on the financial statements. Here's an example. This is McDonald's. Significant summary of accounting policies. Property and equipment. Property and equipment are stated at cost with depreciation and amortization provided using straight line method over the following useful lives. They use 40 for a building, leasehold improvements for the lesser of the life or the terms, which is generally a certain option periods, and equipment is 3 to 12 years. So then they give the totals of land, buildings, and improvements owned, building lease, signs, equipments, and seating, and other. And then they give a total of accumulated depreciation and net plant and equipment. Then it says depreciation and amortization for property and equipment in millions were as follows. And then they give you 17, 16, and 15 in the note. So why would McDonald's select straight line method? Straight line is most widely used and easily understood by all depreciation methods. The straight line method tends to produce a higher income and shareholders' equity amounts compared to accelerated. Furthermore, many of McDonald's fixed assets, leasehold improvements, machinery and equipment, furniture and fixtures, may provide benefit evenly over a lifetime instead of the results of which consistent with straight line. So McDonald's discloses the estimates. The depreciation calculation varies, estimates of service life, and residual value. The disclosure of these items allows users to gain insight into the company's fixed asset. Such analysis may yield insights to the company's competitive position, capital replacement policy, and profitability. What are some additional issues? So there are partial periods for depreciation. There's changes and corrections, and then there's depreciation, accretion of assets, retirement obligations. So for partial periods, well, our previous discussion, the assets were purchased on the first day of the year and disposed on the last day. This seldom happens in practice. Therefore, it would be necessary to round to the wholest convention month or year or half-year convention. So Van Company purchases 6,000 in assets with a 3-year life, no residual value on August 18th. If Van uses the wholest month convention, they should record 4 months, September, October, November, and December of depreciation, and 12 months in the second and third years. So then on the following year, at the final year, they'll use the depreciation. So 4 months, 12 months, 12 months, and then the final 8 months that went with this 4 months, would be depreciated here. So you'd still get to the same total. You just spread it over 4 years instead of 3 because you're doing a partial year in the first year. If they had a useful life with, here's how it would look. So the computation, annual depreciation is 3,000. 4 months would be 4 divided by 12 times 3,000, or $1,000. Then they have $2,000 and they have 12. So if they're going to take part of the third year, so this is, they're going to take 3,000, they're going to take 8 months of the 3,000 and then 4 months of the 2,000 in this year. And then they're going to take 8 months of the 2,000 and then 4 months of the 1,000. And then they'll take the remaining amount in the following year, which is 8 divided by 12 times the 1,000. Again, you still get to the $6,000. If Van uses the nearest whole month convention, so this is partial depreciation, and this is double declining balance. So in this case, they would have annual depreciation 4 months, so 4 divided by 12 times 4,000. So they would have 1,333. And then they would take that, they would take the annual depreciation, and then they would multiply by 8 by 12 for the 4,000 and 4 by 12 for the 1,333. And then they have 667 left. So double depreciation would accelerate it. Therefore, it would only happen in 3 years. We'll do more examples of this. If Van Company purchases a $6,000 asset with 3 years, no residual value, and they use nearest whole month to calculate, it should be recorded 4 months of depreciation in the first, 12 on the second, and third, and 8 in the fourth. So this is half year convention. So instead of doing months, they'll just call it a half year if you didn't buy it in the beginning of the year. So annual depreciation times 50%. So they'll do the 1,000, then 2,000, 2,000, and then 1,000. Again, we still get to 6,000. So this is different ways to do a partial year. So this is sums of the year's digits. So we'll do an example of this, but they have the annual depreciation of 3,000. Then they have 1/2 times the 3,000 is 1,500. And then they have the 2,000 annual depreciation, 1/2 times the 3,000, then 1/2 times the 2,000, because we're doing half year, half year. Then they have the 1,000, so they have 1/2, the other half of this 2,000, and then they have half of this 1,000, and then they have the final half. So if you want to change your depreciation estimate, depreciation expense is based on estimates of service life and residual value. As new or additional information becomes available, a company may find it necessary to revise its estimates of service life, residual value, or both. A change in estimate will result in a recalculation of depreciation expense, which is accounted for prospectively, which means going forward. The company allocates the remaining book value of the asset at the beginning of the year of the change over the new remaining and considering the new residual value. So let's go over an example. In 2014, Kelman Company bought a machine for $200,000. At that time, Kelman estimated the machine would have a useful life of 10 years and a residual value of $20,000. Kelman uses straight line and depreciates its machine at a rate of $18,000 per year. On January 1st, 2019, 5 years later, the machine had a book value of $110,000. Kelman determined that the remaining useful life is 4 years and residual value is 10. So from 2019 forward, it would record depreciation as 110 minus 10 divided by 4, or 25,000 per year instead of 18. A change in depreciation method for currently owned asset is accounted for prospectively. However, this change requires a justification as to why you would choose a new method is preferable. For example, a company may change its depreciation method because of a change in estimated future benefits it expects from that asset. Or when a company changes its depreciation method, the company allocates the book value of the asset at the beginning of the year change over the remaining life and while using the new depreciation method. This change is called an accounting estimate and is affected by a change in accounting principle. A correction in an error in depreciation is accounted for as a prior period adjustment. The effect of current period financial statements involves a correction to the amount of accumulated depreciation account and an adjustment to retained earnings, net of income tax, for any amount in error previously reported in net income. The company's previous financial statements are also corrected, which means restated. So if there's a correction and an error, you have to go backwards and restate financial statements. If it's changing an estimate, that only goes forward. You don't restate financial statements. And then if there's an acquisition and use of operating assets may create an asset retirement obligation, ARO, which is a legal obligation related to the retirement of this asset. The fair value of the obligation is initially recognized as a liability with an offsetting increase in carrying value of the related asset. In subsequent periods, the asset is depreciated over the service life. In addition, the company recognizes accretion expense and increases the asset retirement obligation each year it uses it. Accretion expense is classified as an operating expense and results from the increase in carrying value of the liability associated with the retirement obligation. It's computed by multiplying book value of the liability by the discount rate to compute the original present value of the asset retirement obligation. So let's talk about an example. On January 1st, Reed Company spent $100,000 in the interior redesign of a retail store, acquired a 10-year lease. Reed recognizes $12,000 in asset retirement obligation related to the leasehold improvement. Reed depreciates the asset over 12 years using straight line, no residual. Reed would make the following entry at the end of the year to record depreciation. 112, so we add these two together, divided by 10 is 11,200. In addition to this entry, they must recognize an increase in the present value of the asset retirement obligation. So we assume that a discount rate of 10%. So 12,000 times 10% is 1,200. So the retirement obligation, so they call it accretion expense, and we're going to credit a retirement obligation, which is a liability account. We also have impairment of plant, property, and equipment. Plant, property, and equipment generally reported on the balance sheet at its historical cost minus accumulated depreciation. Because depreciation is an allocation process and does not attempt to measure fair value, situations may occur when future economic benefit or service of an asset decreases below the book value. This is called impairment. To faithfully represent the asset's values, we suggest that a company should write down the assets and recognize a loss. GAAP requires that companies review plant, property, and equipment for impairment whenever events or changes in circumstances indicate the book value of the plant, property, and equipment may not be recoverable. Examples of such events are as follows: significant decrease in fair value, significant change in the way the asset is used, significant change in the business or regulatory environment, cost of constructing the asset exceeded the planned amount in the current period operating losses, negative cash flow from operating activities, or its expectation the asset will more likely than not, which means more than 50% chance, be sold and otherwise disposed before its end of its useful life. After the company identifies events or circumstances that exist and indicates that the asset has been held and used may be impaired, a company will apply a two-step procedure to measure impairment. 1. Test for recoverability test. So test for impairment, a company first groups the assets at the lowest level, which is identifiable cash flows are largely independent of cash flows of other groups of assets. We will use the singular term asset to describe a group of assets. Next, the company estimates the future net cash flows expected as a result from the use of this and its eventual sale. Continuing on with step 1, if the total undiscounted cash flows are less than the book value of the asset, the book value is not recoverable, and therefore the company must recognize an impairment loss. If the total undiscounted cash flows are greater than or equal to the book value, the company recognizes no impairment loss. So the measurement of the impairment loss is step 2. If the recoverability test indicates an impairment has occurred, the company measures the impairment loss for an asset that it intends to hold and use as the difference between the book value and its fair value. The fair value is the amount at which the asset can be sold in an orderly transaction between market participants. If quoted market prices aren't available, fair value is measured at the present value of expected future cash flows. If a company uses the present value to estimate fair value, the discount rate of return that the company would require for a similar investment with similar risks. When a company recognizes an impairment loss, it writes down the asset to reduce its book value to fair value. Example of an impairment. On January 1st, 2016, Hall Company purchased a machine for $3 million. The machine is held for use and not for sale. Hall is depreciating it over 10 years, straight line with a zero residual value. Late in 2019, because of technology changes in the industry and reduced selling prices of its product, Hall believes the machine may be impaired and will have a remaining useful life of 5 years. To test impairment, Hall estimates the machinery produces a net cash flow of $300,000 each year for the next 5 years. It uses a discount rate at 6% to evaluate other capital budgeting projects with similar risk. So let's walk through how you would calculate the impairment. So book value is 3 million, less accumulated depreciation, which was 4 years times 300,000, 1.2. So the current book value of the asset is 1.8 million. The undiscounted cash flows is 5 times 300,000 per year, or 1.5 million. Because the 1.5 is less than 1.8, they must recognize an impairment loss. So now we would either put this in Excel or look up the present value table of 300,000 for 5 years at 16%, which is 3.27. So then, therefore, we multiply this, and this 982,288 is the actual fair value. The book value is currently listed at 1.8 million, so we need to make an impairment loss of 817,712. GAAP does not specify how to record the write-down. It does indicate that you must reduce to its new depreciable basis. So it's loss on impairment, credit accumulated depreciation. Hal reports the loss as income from continuing operations on its income statement in plant, property, and equipment as its fair value. So it would have a new fair value of 982,288. Then they will depreciate that over the remaining 5-year life. A company must disclose any of the following information of a write-down and the next 2 years: the description of the impaired asset and circumstances leading to impairment, the amount of the asset's fair value and how it was determined, the amount of the loss, the income statement caption, which includes the loss, and the operating segment affected if applicable. So we're not going to cover impairment losses held for sale because that's a different process. Let's skip through this. So a company may dispose of plant, property, and equipment by sale, involuntary conversion, abandonment, or exchange. When a disposal occurs, a company recognizes a gain or loss in the disposal, which is the difference between the book value of the asset, which is cost minus accumulated depreciation, and whatever consideration you receive in exchange. A gain or loss arises because depreciation is a cost allocation process, and its application does not result in the asset being reported at its market value. Therefore, a gain or loss is considered a correction of income that has been recorded in the year's assets has been owned. The gain or loss on disposal is normally reported in the income statement as other income and expense. However, it could be reported as disposable of a component of a business unit if it meets the appropriate criteria. To account for a disposal of plant, property, and equipment, the company first records the depreciation up to the date of disposal. It then removes the cost of the asset and related accumulated depreciation. Bean Company had a machine that originally cost $10,000. Has accumulated depreciation of 7, and the beginning of the year it's being depreciated 1,000 per year. They sell the machine for $1,200 on September 30th. They must bring depreciation up to date. So they had 9 months. So 9 divided by 12 times 1,000 per year is 750 in depreciation, a credit accumulated depreciation. So then to get rid of the book value, which is now $2,250, and the proceeds of $1,200, you would write a gain or a loss. So they received $1,200 in cash. We have to get rid of accumulated depreciation, which is 7,000 plus the 750 we added, which is 7,750. And then we have to get rid of the asset at 10,000. We take 10,000 minus accumulated depreciation minus cash, and that equals the loss or gain, which in this case is a loss on disposal of a plant, property, and equipment. So we're going to stop here, and we will talk about depletion in another video.